Hello, Matthew Bell with InsurancePrescription.com, and today I wanted to talk about 6 different options you have for your required minimum distribution if you don't really need the money. So every year the Internal Revenue Service requires after the age of 70 and a half that if you have money in a qualified retirement account, you have to take out a little bit of money, and it's called a required minimum distribution or an RMD. Now, I get into this more in detail in other videos. I have a video just on the procedure for taking RMDs, the forms that are required from the IRS and from your local account holder. I also have an informational video about some of the ins and outs of the RMD, what it is, when you have to take it, what's the required beginning date, and there are some little niceties about that, especially the first year. But generally, after the first year, you have until December the 31st of whatever year it is in order to take your RMD. Now, obviously, if a person is taking distributions from a traditional IRA or a 401k, then they may or may not be satisfying their required minimum distribution, but it's one thing if you need that money to live on, and it's another thing if you think, well, you know what, if it weren't for the required minimum distribution, I would really just leave that money alone. So that's kind of what this video is geared towards addressing. And I'm going to give you 6 different suggestions. Now, the suggestions are going to vary in terms of a number of things. They're going to vary in terms of your situation, your needs, your expectation of future need, your appraisal of the tax landscape, as well as other preferences that you have regarding legacy planning and things like this. But let's get into it. So the first option that you would have for your RMD would just be to take it and to give it as a gift to a son, a daughter, a charitable organization, or a YouTuber. Kidding, but worth a try, no. But seriously, you could just take your distribution, pay the tax on it, and then give it away. Now, the gift tax exclusion in the year 2019, I'm recording this in November of 2019, is $15,000. It's been that way for a couple of years anyway. And the lifetime exemption basically follows the estate tax exemption, and so for a single individual, the exemption is $11.4 million. So that means if you're going to give more money than the $15,000, it is taxable in principle, but if it falls under the lifetime exemption limit, then in practice you probably won't be taxed on it. This is as good a time as any for me to bring in the usual disclaimer. I am not a financial advisor. I am not a tax preparer. I cannot give you advice on investments, on taxes, on savings, on retirement. This is only for general informational or entertainment purposes only. You need to consult with an expert in your area if you need personalized recommendations, somebody that can sit down with you and at least ask the kinds of questions that would be necessary in order to get a fuller picture of your financial situation before specific advice can be given. Now, of course, if you take a distribution, you just take your required minimum distribution, then it's going to be added through a 1099-R. You would have that distribution reported to the IRS via your tax preparer, would be added on to your regular income, and you would pay income tax on that at your usual income tax rate. Now, there is another way. So way number 2 to deal with your required minimum distribution and still give it as a donation would be as a qualified charitable donation, or a QCD. Now, a QCD differs from the kind of donation that was just described, which is basically just a gift. QCD, or a qualified charitable donation, differs from a gift in the sense that you never physically touch the money. So unlike the first scenario where you just take your distribution and then you yourself disperse it, with a qualified charitable distribution, you simply earmark it for a particular charity, and it goes directly from your IRA, let's suppose, directly to the charity. You never touch it, and in fact, that will, if you match it to your required minimum distribution, will enable you to avoid having to pay income tax on your required minimum distribution. Now, you can exceed the required minimum distribution in terms of your charitable donation, but there is a limit in 2019. It's $100,000 per person. And some of the reasons why a person might choose to do this is to keep down the amount of income that they report. So as we just discussed with respect to the gift, if you take a distribution, it will be added on to your adjusted gross income and factor into the amount of taxes that you'll have to pay. Beyond that, if your income rises above a certain level, and it's $85,000 for an individual or $170,000 for a married couple filing jointly, you will actually pay an additional charge or surcharge on your Medicare premiums. And in addition to that, that kind of income, what's called provisional income, might also increase and probably will increase the amount of money that you have to pay tax on in terms of Social Security benefits. So the percentage of your Social Security benefit that is taxed is going to depend on your reportable income. It could either be nothing, it could be 50%, it could be 85%, but you're going to have to pay more on your Social Security benefit the more income you report to the IRS. Now, if you would want to reduce the amount of your required minimum distribution without actually having to take a portion of it this year, one option is a Qualified Longevity Annuity Contract, or a QLAC. Now, the idea of the QLAC basically appeals to people who think either that their tax situation is going to be better going forward, or is at least going to be the same as it is right now, and they're just simply trying to reduce the amount of the required minimum distribution that they have to take. The required minimum distribution, as I get into in another video, link in the description, is calculated on the balance that you had for your IRA as of December the 31st of the previous year. So the Qualified Longevity Annuity Contract cannot exceed 25% of that account balance, or $130,000, which is the hard upper limit. But for the money that gets placed into the Qualified Longevity Annuity Contract, or QLAC, you don't actually pay income tax on that, and so you would reduce the amount that your RMD is calculated on. So the required minimum distribution is essentially calculated on your account balance as of December the 31st, the previous year, and then that account balance, or all susceptible balances, are then divided by your life expectancy factor, or your RMD divisor, and that comes from IRS tables, and the resultant number is the amount that you're required to take out of your qualified retirement accounts. So just to use a very quick example, say you have an account that has $200,000 in it, and you're going to put 25% of that account into a Qualified Longevity Annuity Contract, where you're going to put $50,000 into that Qualified Longevity Annuity Contract. Well, then instead of your RMD being calculated on an account balance of $200,000, now your RMD is calculated on an account balance of $150,000, and that's going to effectively reduce the amount of the RMD. Now, the Qualified Longevity Annuity Contract is an annuity that kicks that tax can, so to speak, down the road. You would be taxed on the money in the QLAC when you go to take distributions, or when it is annuitized. Now, as current rules stand, you can delay taking distributions on that as late as age 85. If you take it prior to that, which you can do, you would start paying tax on the money as soon as you elected to start receiving distributions. Now, that option really appeals to people who believe that their tax situation is going to be better moving forward. In another video, I get into some of the reasons why a lot of people today do not think their tax situation is going to be better moving forward. And in a nutshell, it pertains to the fact that tax rates are historically low, and meanwhile the deficit and a lot of the unfunded liabilities the United States has are historically high. You can visit the U.S. debt clock and see the quite ponderous counter that continues to scroll morning, noon, and night, and it's up around $23 trillion for the deficit, with $126 trillion in unfunded obligations. Many people think that money is going to have to come in the form of tax hikes in the near future, and if so, your tax burden on your qualified assets might very well be increased significantly. And then that perspective paints the required minimum distribution in an entirely different light. Namely, some people believe that the best strategy is not simply to take the minimum, but to take more than the minimum. And if that's the case, you can actually try to pull the money out of that qualified contract, which has the tax liability attached to it, and settle up the taxes now while the income tax rate is known and historically low, and then dump the money into something else. There's a number of ways that you can do that. That basic idea is that when some of these contracts were put in place in the 1970s, the highest marginal tax rate was around 70%. Now in 2019, the highest rate is about 37%, excluding the tax that you would pay for Obamacare, which could push you into the 40% or higher bracket. However, when you think about the tax liability that the government has in terms of the deficit and these obligations, the prospect seems very likely that tax rates may have to go up in the near future. Now, the first strategy then would simply be to take your required minimum distribution or take a little bit more and throw it into some other investment vehicle. And in essence, the idea there is that you would be, again, settling up taxes at the rates that they are now. While we know what the tax rates are, and while they are low, may not feel like they are, but they are, you're settling up the taxes at a known low rate and then dumping the money into another vehicle. Any number of ways you can do that. Number one, you could put it into some kind of a money market savings account or a certificate of deposit that is a CD. Now, obviously, the name of the game there is to try to get the best interest rate that you possibly can, which can kind of push people into a separate option, which is similar. It's the second option there, or our total option number 5, which is to put it into some kind of an annuity contract that's not a qualified longevity annuity contract. So for instance, you might do a Roth conversion on all or a portion of your funds, or you might take your distribution and then throw the money into a non-qualified annuity contract. If it is a fixed annuity contract, then again, it would simply be a matter of comparing the interest rate that you're getting in the contract to other comparable rates from competitor companies or from high interest savings accounts, money markets, and that kind of thing. Now, the sixth and final option that I'll present in this video is that you could actually take the money from your qualified account and use that as premium payments for some sort of a life insurance policy. Now, there's a number of reasons why you might do that. Number one, a life insurance policy that has cash value can be, if it is funded correctly, it can be a CD alternative or a savings account alternative. That works in a number of different ways. We can sometimes think of the cash value life insurance as having a higher internal rate of return or interest rate than a comparable CD or than a comparable savings account or money market. The other thing is that when you put money into a cash value life insurance policy, your beneficiaries don't just get the cash that you saved, they get the death benefit that is available based on the premium outlay that you have provided. Some people favor life insurance even over a Roth because whereas the Roth has a number of advantages, including that you would get cash distributions from it without paying tax on the gain if the Roth has been open for 5 years and if you're over the age of 59 and a half. In a life insurance policy, there is no 5-year rule that applies. However, cash distributions that are taken tax-free would have to be done as a loan payment rather than as a surrender, or you might be susceptible to taxation, or the cash that you take might be taxable. However, life insurance can be an extremely attractive option, especially for folks that, as they get into their 60s, 70s, and 80s, start to ponder their mortality and realize maybe that they are not going to spend all of their money. Life insurance, because in terms of income tax anyway, it is tax-free to the beneficiary, it can sometimes be a more advantageous vehicle than, say, leaving money in an IRA when it comes to beneficiaries. And just one quick example of that, let's say you have $100,000, $1 million, whatever it is, in an IRA. If you die and a non-spousal beneficiary becomes the beneficiary of that, becomes the inheritor of that money, then they would have to actually settle up the tax. If it's a non-spousal beneficiary, then the tax bill becomes due. There's usually a number of ways to pay that. Under present rules, they can either take a total distribution of that account within 5 years, or they would take required minimum distributions over the beneficiary's life expectancy. And again, that would be a function of the IRS's life expectancy tables. So let's say you have $100,000 and now the tax bill is due. Just making an assumption that your beneficiaries are in the 25% tax bracket, may or may not be true, but just to make the math easy, if you knew that you were going to leave $100,000 in a qualified account, and of that amount, $25,000, let's say, was going to have to be paid in taxes, you might then realize your beneficiaries are going to be splitting $75,000. Now, if you knew that was the case, you wouldn't know, but if you did know, you might decide you wanted to take that $75,000 yourself. So if you took a $100,000 distribution, completely liquidated the IRA, paid the tax yourself, and then put $75,000 into, let's say, a cash value life insurance policy, between the ages of about 60 or 70, you might expect that the premium to death benefit outlay might double your money. In other words, $75,000 of cash into the policy might purchase $150,000 thereabouts in terms of death benefit. And that is tax-free in terms of income tax to your beneficiary. Now, there's a number of considerations. As we said, taking an overly high distribution can bump you into the next higher tax bracket, can cause you to have to pay Medicare levies and other things more taxable. Your Social Security benefit can be more taxed than it would have been otherwise. So there's a number of different concerns. Part of it depends on what you think is going to happen in terms of the tax landscape in the next few years. Another consideration is the amount of legacy that you actually want to leave. There are a number of things, but what I would encourage you to do is sit down with somebody who's knowledgeable in these options, run through the numbers, see if they make sense. Some of the options require steps to be taken, like for example, life insurance policy obviously would require that you're healthy enough to get it. You'd have to go through underwriting. Some of the other policies, different annuities and things like that, would not. As always, it's probably wise to consult various different advisors, tax preparer, money manager, life insurance agent, to get a kind of a well-rounded perspective. But if something that I said in this video was of interest to you, please click the like button, please subscribe, click the notification bell to be alerted to new content as it becomes available. I thank you so much for joining me today, and I look forward to seeing you again in another video.